day's wasting away. What would be something really cool we could do?
You could listen to Money Life, where you're going to get takes on the market like this one.
We do think there's a reasonable potential for some downside. And I think if that happens, and there's always going to be a pullback at some point, but if or when that happens, I think you'll see us do what we did earlier in the year, which is take some money out of bonds. We don't think the 10-year yield's going much lower than where it is right now, and put that money towards stocks.
That's Scott Wren, Senior Global Market Strategist at the Wells Fargo Investment Institute. And yes, he sees trouble ahead, but he's very clear that it's not a bubble and that his forecast for the S&P 500 for the end of next year is 7,500, which means that, the downturns he sees potentially coming would be buying opportunities. He's our big interview, but we start things off, as we do every Thursday, with Todd Rosenbluth, Head of Research at Vetify, here with his ETF of the week. And then Tobias Carlisle, Head of the Acquirers Funds, returns to talk about his new book, Soldier of Fortune, Warren Buffett, Sun Tzu, and the Ancient Art of Risk-Taking.
Okay, cool.
Yeah, it is going to be cool. This is Money Life for November the 6th. I'm your host, Chuck Jaffe. Thank you so much for joining me. Again, I am so appreciative of the folks who are going above and beyond the call because they're finding that we're not where they expect us to be on Apple Podcasts. We do want to point out we're not the only show that's having this problem. If you have other podcasts that are not showing up because you use Apple Podcasts, they're in the same boat we are right now. We are trying very hard to get out of that boat, working with them, doing what we can. But in the meantime, we very much want you to go and find our show on other platforms. We hope that's what you're doing. Just a reminder, we have a show every weekday when the market is open. If the market's open, we intend to have a show. Now, if we don't for some reason, power failure, me having health issues, whatever it might be, we're going to put up a placeholder, something that says, hey, we're not here today, but we'll be back tomorrow, or we'll be back whenever, and here's why. We may put up a show that says, here's some past interviews to tide you over, but we're going to be there every single day. That's my promise to you, is that as long as I do this show, I'm going to try to be there for you every day that the market's open. And so if we don't show up, well, it could be the podcast platform. It could be that I'm late or I'm running behind, or maybe sometimes Rob, although usually it's me, not him, in terms of the production of the show. But we're going to be there. Now let's get out of that and get to the stuff that's really important, which is the market things. Great interview. I'm really happy to have Scott Wren back on the show. He's been on the show more than 30 times over the years, but he hadn't been on for like a year and a half. And both of us became grandfathers in that time. And to little boys, we were discussing some things off the air that were really fun to just catch up with him. But then his market opinion is great because at Wells Fargo Investment Institute, Wells Fargo, they deal with retail investors. They're dealing with folks like you and me who are trying to do this. They're not dealing necessarily with institutions. So there's nothing wrong with the people that deal with institutions, but it is good to see them piece it together and put it together. So I think that's a really interesting thing. We did an interview yesterday, I won't say who it was, where they came back afterwards and said, I really hope you'll leave the answer of this in. And I thought, what do you mean that we'd leave the answer in? We don't, as a general rule, edit our interviews. And if we do, we typically tell you. That's because if we're asking the question, we want you to hear it, good, bad, or otherwise. No, I can't say that there's never been a time when we've asked a question and somebody's like, wait, hold it. I flubbed that answer. Could we start again or something like that? That happens every now and again. But what I'm talking about is we don't ask a question and generally go, oh, take that out, or take half of that answer out because the guy ran long. No, we just make me shut up early and start the show and cut this part down if we have to, or we take out an interview. As you know, we sometimes do 4 segments, sometimes do 3 when it comes to the interview segments. We've been doing a lot more of the 3s because I've been letting folks run because there's so much to talk about. You've got a market that nobody should be surprised that it's backing away from record highs, but it's not backing far away from record highs. There's so much news out there. It's going to be reacting more volatilely. Don't spend much time looking. Those quotes we've had from Jason Zweig, and we have one more today because we had an interview with him a year ago today. We've used 3 quotes, and today will be the 4th from that, are all about, don't spend time. You're investing for 30 years. Why do you care what the market's going to do in the next 30 days or the next 30 minutes? It's a great point. one that we don't make often enough. If you've got points that you want to score with me or that you want to see us make on the show, or you want us to talk to somebody who you've heard someplace else, but you want them to get the Money Life treatment, tell me about it. Chuck at moneylifeshow.com is how you reach me. I very much appreciate it when you guys do reach out to us. Take your time doing that. And again, if you've been dealing with the issue on Apple Podcasts, well, we appreciate that you are now listening to us on places like Spotify or iHeart or YouTube or whatever. Thank you for putting up with that. Maybe you'll decide that that's where you want to be. And again, because I am on the side of all podcasters, we're not the only ones having this problem. So if other shows that you like are not showing up or not updating normally, you might want to check them out. And again, if you haven't checked it out, the site we've been sending people to, pod.link, which allows you to basically put in any podcast, you search for it, and then it's like, here's all the platforms. And you can go find our link on Spotify, or you can find us on Opencasts or Pocket Casts or whatever. You can find it in all those places. It's a pretty cool tool that I wasn't aware about until recently, because we're always learning stuff. And we hope you are too. So let us know how we can help you. We appreciate you helping us and just doing what you have to show up every day. Right now, let's get to the talk. We've got a great show. I think you're going to love the interview with Scott Wren, but we've got a very different ETF of the week this week with Todd Rosenbluth, and then Tobias Carlisle. And oh, by the way, we have a contest for not just Toby Carlisle's book, but for Artilo Groniger's book from yesterday's show and for Beth Pinsker's book from Tuesday's show. Yeah, so make sure you stick around all the way till the end, because with 3 books on the line, you got extra chances to win. But we think you're always a winner when you hear the great talk, and that means you're going to be winning when we come back in a moment.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
One fund on point for today, the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds, and we do it with the help and guidance of Todd Rosenbluth. He's the head of research at Vetify, and at Vetify.com, you'll find all the tools you need to make yourself a savvier, smarter investor in ETFs. But this is actually a special edition of the ETF of the week, because we're not going to just focus on one fund. We're going to talk about some news that affects all ETFs, the entire ETF industry. And while we're at it, we'll cover a couple of funds in the process. Todd Rosenbluth, it's great to chat with you again.
It's great to be back.
Your news about the ETF industry is
$1.1 trillion and counting. That's the amount of money that has gone into ETFs thus far this calendar year. We are just about to cross a record, and I'm super excited.
$1.1 trillion year to date, basically through Halloween Day. Talk a little bit about the record and talk about why you are super excited, because it's the numbers are meaningful here.
Right. So what we crossed the $1 trillion mark towards the end of last year. And so we ended with $1.12 trillion, according to the data that we get at Vetify from FactSet. So we're 2 months ahead of schedule, or almost 2 months ahead of schedule for setting a record. I had expected that we would have seen a bit of a slowdown in terms of ETF adoption coming into the year. We had a new presidential administration. I thought the market was going to be volatile. It has been, but it's the market, being the equity market, has bounced back. We've already seen a record of flows for fixed income ETFs. That happened about a month ago. It hasn't slowed down. We've seen demand for international equities. We didn't have that as part of the roadmap a year ago. And gold and cryptocurrency both accelerating together at the same time in terms of ETF adoption. There's so much to be excited about in the ETF industry. And those numbers just show how more and more ETF investors are considering these products.
Let's talk a little bit about how the numbers break down, because there have been a few stories for the market this year, whether it's how well gold has done, how well international investing has done, what's been going on with large cap growth, all those other sorts of things that have kind of made the news, and the evolution of cryptocurrency funds and the rest. But in this rush of money coming in, what's been the most popular?
Well, so we talked about it last year, and I think we talked about it again this year. Vanguard 500, the Vanguard S&P 500 ETF, VOO, it has already crossed $100 billion of net inflows. You know, Chuck, the only ETF to cross $100 billion was the Vanguard 500 ETF. It did it last year, so it's in a class of its own, repeating likely as the MVP of the ETF industry in terms of asset gathering. We've seen demand for other S&P 500 index-based products, SPYM, that's the new ticker for the State Street low-cost S&P 500 ETF, IVV, that's iShares S&P 500 ETF. Those three ETFs are at the top of the leaderboard. But you're right, we did see cryptocurrency, IBIT, be very popular this year. We've seen GLD, which is the State Street Gold ETF, be very popular this year. And perhaps we'll come back to it to dive a little deeper. But actively managed ETFs, I know I've talked about them a lot on this program. Well, almost 40% of the net flows this year has gone in to actively managed ETFs. So this is not just an index-based world. The money certainly reflects that.
What is the trend there? Because obviously we have seen a significant evolution in actively managed ETFs, because until a few years ago, they weren't really a thing and they came in slowly. But as we're talking about growth, more flow into ETFs, more that's happening, have we seen that share, not just the amount, but that the share of total inflows for active ETFs is growing as well?
Yes, it is. So we're now at a large enough critical mass that when you get roughly 40% of the flows, you're now moving the overall asset needle. Nowhere near as strong. It's over 10% of the overall assets. There's still a lot of money that's in index-based products. And when the S&P 500 continues to go up in value, then that asset base that's tied to Vanguard 500 and the iShares product and the State Street product do well. But what we've seen this year is that institutions, some of those that are running model portfolios for advisors, as well as individual investors, they're embracing actively managed ETFs. So I know I've talked about DYNF beforehand. That's an iShares active factor ETF that gathered more than $10 billion so far this year. I think we might have talked about the Janus Henderson CLO ETF, JAAA. That has been very popular with investors this year. So it's both been active equity and active fixed income that has been gathering assets.
There have been some new fund types introduced this year. In fact, you and I have talked about a number of them on ETF of the Week, particularly when they involve option strategies, covered calls, things along those lines. How much traction have they gotten? I would not expect it to be significant among the 1.1 plus trillion in assets that we've seen this year, but is it significant in terms of they're gaining a real foothold, or are they still kind of outliers and oddities?
So I don't think they're outliers and oddities. In fact, I was just looking down to be able to see. So JPQ, that's a JP Morgan NASDAQ equity premium ETF. That is close to $10 billion for the year. That's leading the overall charge. But we've seen NEOS have a lot of success. I know I've talked about some of the NEOS individual ETFs. Those products have had success this year. We've seen covered call ETFs that are more narrowly focused as well. So I don't have in front of me the percentage of assets that or percentage of flows that have gone in to covered call ETFs, but we are seeing covered call ETFs gain traction. That's in part why, we're talking about them. We usually are coming to talk about the ETF of the week, either because something was new and caught my and our team's eye, or because the money has gone into it and we wanted to be able to raise the flag as to what's happening. So we're seeing both of those happening within the covered call space.
As for the flows this year, obviously ETFs keep taking a bigger share of money. So you get some of that just as a natural migration, as people are saying, okay, I'm not putting more money into my traditional mutual funds or what have you. We're seeing that flow into ETFs. But are we also seeing people setting aside more money? Like, where are all these new inflows coming from? It can't all be traditional funds, can it?
You're right, it isn't. So we have seen net outflows from equity mutual funds, and some of that money is going into ETFs. But we've seen money, I believe, going into fixed income mutual funds at the same time that money is going into fixed income ETFs. So some of this is a market share shift from mutual funds to ETFs, but it's also just as people are investing in ETFs, they're getting more comfortable in using ETFs as part of their overall practice if they're an advisor or as an investor building portfolio. And then they continue to put money to work, whether that's a replacement from a mutual fund, replacement from a individual stock to get the liquidity and the diversification benefits, or I've got more money to invest as an investor. I'm going to put that to work into ETFs. And so that's why I regret thinking that the ETF market was going to slow down. I no longer believe that. I believe in 2026, we will again break $1 trillion of net inflows because of how well we've done back-to-back years.
If the market takes a breather next year, not that a lot of people are already forecasting that or anything else, but if the market takes a setback, how much do inflows take a setback? Are you willing to hold to that forecast that inflows will keep going regardless of market conditions?
Well, what's the phrase? You show me new facts and I'll change my opinion. So I guess let's see what happens in 2026 and how, if the market sells off that much. But historically, what we found is that when the market sells off, people turn to ETFs, because if your position in a mutual fund is at a loss, you can sell that at a loss to get the tax benefits of doing so and moving into something that is cheaper. So for people who have been sitting on the gains the last 3 years, they're probably less likely to sell out of something that's working and then pay that tax consequence and move it into something perhaps cheaper, perhaps a more stable performer in the ETF world. But if the market sells off, that is likely an opportunity for ETFs to gain market share. Will it be enough market share to generate $1 trillion of flows again? Sure. I'll say that to you in early November of 2025, that I think that 2026 will have $1 trillion of net inflows. I hope to be back to talk more about it.
And I will hold you to it when you come back. But of course, you'll be back plenty of times between now and then, because we're doing the ETF of the week, which means we'll talk to you again next week. Todd, great stuff. See you then.
Thank you.
Todd Rosenbluth is the head of research at Vetify. Go to vetify.com for more information on all your favorite ETFs and to make yourself a better ETF investor. And of course, Todd starts us off every Thursday, and we are just getting started. Next, we're talking with Tobias Carlisle about Soldier of Fortune, Warren Buffett, Sun Tzu, and the ancient art of risk-taking. And then the big interview with Scott Wren from the Wells Fargo Investment Institute. This is Money Life.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Did you know that there are at least 23 million American adults who can't read a want-ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents.
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The Book Interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
We can start the story. The story today, what's going in directions that, even though I love financial history, it's going in directions that are not normal for financial history. But if you're a student of history, you're going to like this one. If you're a student of Warren Buffett, you're going to like this one, because my guest is Tobias Carlisle, who, of course, was recently on the show doing the market call in his role as the founder of the Acquirers Funds. And you can learn about them at acquirersfunds.com. But he has recently released his 5th book. It is Soldier of Fortune, Warren Buffett, Sun Tzu, and the Ancient Art of Risk-Taking. We, of course, have it linked up in our guest page and in our show notes, and we've got copies that we're going to be giving away in a contest, so make sure you stick around for the details for that at the end of the show. Tobias Carlisle, great to have you back on Money Life.
Thanks, Chuck. Great to be here. I love that intro for this segment.
Well, this is a very different story because, Sun Tzu is not realistically where folks are thinking about. It's the art of war and what have you. I always think when we say, okay, let's try to equate investing to war, that we've gone to a place where there's issues. But you equate what Sun Tzu was talking about and his strategy with Warren Buffett's strategy. Explain a little bit about how you decided that Sun Tzu was not just a master tactician, but a master investor. And then B, how you decided that he was Warren Buffett's role model.
Well, I agree that it does sound like a very long bow, but let me explain the train of thought to you. Benjamin Graham was Buffett's teacher. He taught at Columbia, and Buffett worked for him. One of Graham's most famous books is The Intelligent Investor. So he's also written Security Analysis. So security analysis is really the mechanics of investing. The Intelligent Investor was about the temperament or the psychology of investing. And that's really what Sun Tzu's book, The Art of War, is about. It's not about war. It's about temperament and psychology in games with a risk of ruin. So investing is a game with a risk of ruin. Ruin is something that occurs when you're completely busted, you lose all of your capital, and you're unable to continue. And so Graham talked about avoiding ruin. And really, it's a psychological more than a knowing what you're doing. And the way that folks get caught up is they either in a market where it's very bullish and booming and bubbly, and it makes it look like it's easy to make money. That's when it becomes the most treacherous. And it's easy to experience this FOMO, as the kids call it, fear of missing out, and to buy things that have run a long way, but perhaps don't have the fundamentals there to justify it. And on the other side, when we have crashes, it's easy to panic and sell out, and perhaps you're selling out at an undervaluation. And so the thing that is driving that suboptimal behavior, shall we call it, is emotion or temperament. And that's really the thing that Sun Tzu spends the most time talking about in his book. It's not so much the mechanics of warfare as it is the psychology of not participating. And he says it's the person who gets angry or afraid or forgets that there is this risk there that is the one that gets caught, rather than the person who doesn't understand what they're doing. And I think that's Buffett's message too, that it is really more temperament and psychology than it is really sort of knowing what you're doing. And that sounds like a funny thing to say, but he says that it's not so much a game of intellect as it is a game of temperament. So you don't have to be super smart to do it. You just have to be someone who doesn't get wound up, doesn't get caught up in the prevailing emotion of the day. That really seems to be the secret to being a good investor.
Warren Buffett has been invoked in a lot of books. They don't all get his style right. He's also been invoked by a lot of investors who tell me they're Warren Buffett style investors. And it's little tweaks here and there that they make fairly significant differences. If you're 1 degree off of Warren Buffett, you aren't getting to the top of the mountain the same way he got to the top of the mountain. And we have your book that we're talking about. We're also talking about Ardal Low-Groniger, who wrote the book, The Perceptive Investor. He's a Buffett style investor as well. How much do you believe that at this point, everybody who is talking about Buffett, yourself included, fully understands Buffett? Because I can tell you your style of value investing, very different than the style of value investing we're discussing in the other book interview, yet you're both Buffett oriented.
I would say that I am not so much a Buffett style value investor because I tend to be more focused on cyclicals and deep value. And that's the distinction that I always try to make, that Buffett would be a more growthy. But I do think that what he does is much, much more difficult to do and requires the sort of genius level intellect that he possesses. When I talk about Buffett in this book, I use 3 of his iconic acquisitions that I think have been a little bit misunderstood by the market to illustrate some broader strategy that he has. So one of them is Berkshire Hathaway bought General Re, which is an insurer, in 1998. And I think that a lot of the way that we think about that is shaped partly because Buffett is quite humble. He always talks about his mistakes. He talks about that the thing that everybody remembers about the Gen Re acquisition is that General Re had this derivatives book that he didn't understand or he didn't know about when he bought the business. And he took a little bit of time to unwind that because derivatives can be very complicated transactions. It's just a contract with two parties on either side, but they can be so complex that both parties think that they're winning at the same time, which is impossible because one party has to make a payment to the other party at the end to close out the contract. So I used Gen Re particularly because Buffett was he was a beneficiary of his success with purchasing Coca-Cola in the early 1990s. He put about a third of Berkshire Hathaway into Coke. Pretty quickly, 2 or 3 years later, it had gone up 3 times, and so it was a big part of Berkshire Hathaway. By 1998, it had gone up 14 times, and it was a very big part of Berkshire, and it was trading at 40 or 50 times earnings, which is expensive. And on top of that, Berkshire itself was trading at 3 times book value. So Berkshire was very, very expensive. If you sell Coca-Cola at that point, you incur this 35% capital gains tax. So he didn't want to do that. But the way around it was to merge with General Re, because General Re was an insurer, but instead of holding equities the way Berkshire did, it had a big bond book. And so by merging the two and issuing stock in Berkshire to the shareholders of Gen Re and then taking over Gen Re, that asset then moved into Berkshire Hathaway. So when the dot-com bust happened and Coca-Cola was eventually cut in half, it traded down 50%, but Berkshire itself managed to avoid most of that carnage because the bonds in Gen Re rallied, where sometimes there's this flight to quality when there's an event like that. And the rally helped Berkshire avoid the bust in 2000. And then on top of that, it gave it a whole lot of capital that it could reinvest at much, much cheaper equities. And so it really set Berkshire up for the next decade or 25 years since that event. But then after the fact, Buffett sort of talks about it as a mistake. He calls the derivatives book weapons of mass destruction. And so folks get this idea that perhaps it was a mistake or it wasn't a particularly interesting transaction. But I think that it illustrates the way he thinks about investing, which is there are certain times when you need to be defensive. And this is an idea from Sun Tzu, and this is where this idea comes from. You need to be able to survive. You need to be defensive on certain occasions, and you need to think about the risk. And I think that's a great illustration of him using that sort of strategy and then turning it into offense when the market finally did bottom and he had that capital to reinvest long.
I will point out that I can say that I started buying Coca-Cola stock right around the same time that Warren Buffett did. And I still own it today, but I did not have the ability to avoid the hammering in the middle and the capital gains if I'd wanted to get rid of it, which is probably why that difference. That's why he's the great investor and I'm not. The book breaks all of this down to 13 basic, I want to say rules, but I think you say laws in the book. You call them 13 laws. We don't want to give away too much of the book because the book's a short, easy read. But if you had to tell one to give people a taste of which law you want to know that ties together Warren Buffett and Sun Tzu, which one is it?
Well, I think that the one that I discuss, the very first one in the book, is the one that I think is the most important. And I use the 13 laws because it mirrors 13 laws of Sun Tzu's. And so I try to divide the book up into 3 parts where we discuss 3 of these big transactions. So the Gen Re acquisition is one transaction. And then he bought Burlington Northern, BNSF, which was a railway. And at that time, he was known for buying these asset-light compounders, the idea being that they don't require a great deal of investment to keep on going up over time. And here he is buying a railway, which is really the poster child for being CapEx heavy. They require enormous investments in terms of capital expenditure. And so it sort of defied the market's expectations for the sort of things that Buffett liked to buy. But as it turns out, what he had seen was that Burlington Northern had this geographic distribution of rail lines that went out to the Pacific. And the US was sort of transitioning from being focused on Europe to being more focused on Asia. At the same time, it's about a third cheaper to ship by rail rather than trucking. And there are lots of other advantages, including that it's just impossible to replicate BNSF's network. And so I use that as an illustration of this idea of coup d'oeil and doing this sort of analysis. So one of the things that Benjamin Graham talks about is how much analysis is required to make a decision. And this is something that Sun Tzu talks about as well. Then after you've done this analysis, what you're looking for is an overwhelming advantage to doing the thing, putting the position on, making the acquisition, buying the stock. And so Burlington Northern had this overwhelming advantage just because of the geographic nature of its rail lines and its low cost to ship stuff over those rail lines. And so I think that I said that it gave Buffett the coup d'oeil, which is this French word, which means a stroke of the eye. And the idea is that these people who are great investors or great strategists, the great generals of old, could see some very complicated situation and at a single glance could figure out what was going on and what needed to be done. So at the very beginning of the book, my favorite of the laws is about developing this coup d'oeil. And so I say, develop the coup d'oeil, an intuitive grasp of a complex situation through study and experience. Use the coup d'oeil to understand the implications of small changes and act early. I really do think that that's one of the keys to being an investor, is being involved in the market, keeping an eye on all of these events, and then waiting for that small change that really creates an entirely new picture for what can occur. And I think that Buffett, more than anybody else, has the great skill of doing all of this reading that really you might not know what it's for at the time that you're undertaking this reading, but later on you find that something that you've learned becomes very important, and that small change is the phase shift, as they call it. And so I think that that's what he did with Burlington Northern, where railroads had been a terrible investment for 80 or 100 years before then, but he was able to find that moment when they became a great investment again.
It's a great story. And again, there are other great stories in the book. There are 13 laws that you want to see how Warren Buffett and Sun Tzu come together. Tobias Carlisle is the guy who put them together. Tobias, this has been great. Thanks so much for joining me on the show to talk about it.
Thanks for having me, Chuck. It's always a pleasure. As I say, you're a gentleman and a scholar.
Tobias Carlisle is founder and managing director at the Acquirers Fund. If you want to learn more about the funds, well, you can go to acquirersfunds.com. If you want to learn more about the book, which is Soldier of Fortune, Warren Buffett, Sun Tzu, and the Ancient Art of Risk-Taking, look for the link. We have it in our show notes and on our guest page. We have copies that we'll be giving away in a contest, so make sure you're getting involved in that. Well, it's not the art of war that makes us take commercials. It's the art of podcasting. We need to take a quick break, and we'll be back with more, so stick around. That's how you win here on Moneyline. Welcome to the big interview on the November 6th edition of Money Life. Joining me now, Scott Wren. He is Senior Global Market Strategist for the Wells Fargo Investment Institute. One of my favorite people to talk to, and I say that in spite of the fact that we haven't talked now on the show for like a year and a half. That's in part because Wells Fargo Investment Institute has not just Scott Wren, but Daryl Cronk, Paul Christopher, others. And so they spread the wealth around. But if you want to learn what they're doing, you want to see their commentaries, and there's a bunch of great stuff there, including Scott's most recent one, which we're going to talk about, wellsfargo.com/investment-institute. That's how you get there. By the way, there's a direct link to Scott's most recent commentary, which we will discuss in our show notes for today's show. Scott Wren, welcome back to Money Life.
Hey, Chuck, it's great to be here. I can't believe it's been a year and a half since we talked. That has to be the longest stretch in all the years that I've been on your podcast.
Yeah, it most assuredly is, because you've been on the show more than 30 times, just none of them since early in 2024. So let's jump in.
That means we're getting old, Chuck.
Yeah, well, I've already been there for a while, so older is the appropriate adjective at this point.
I hear you.
Let's jump in with where you're at right now first, because it has been a while, but also because we've got a market. It's confusing because you can't go on this long with this much positive and not think there's some negative coming. I've got people saying it's a bubble. I got people saying, no, it's not a bubble. I've got, every kind of output there. We've got a Fed that's cutting at times when it normally wouldn't be cutting. We've got economic data that we now question. Where are you at? What's your base case at this point?
Well, Chuck, I think the base case is that we have some really large mega cap companies, the Mag 7, maybe a couple beyond that, that are really taking over and producing really good revenues, really good earnings, and they're doing a lot of CapEx, all related to artificial intelligence. So for me, and I think of, what carried the market on this last leg to the upside, I think it's just repeated confirmation, whether it's the first quarter earnings, second quarter earnings, or in the earnings season that we're basically through with. It's that these large tech companies keep telling us, yes, we are going to spend as much money on infrastructure and things related to AI as we've been telling you. And as a matter of fact, we're going to increase that number. So I think that has been a huge foundational underpinning for the market. And then plus, let's face it, we've got a 4.3% unemployment rate. Historically, that is very low. And when Americans are employed and they have money in their pocket, they're going to go out and spend it. And that's exactly what's happened. And so I think between consumer spending hanging in there and some really, aggressive AI CapEx spending, I think that's really what's driven the market here. Stocks certainly aren't cheap. I don't know if they're priced for perfection, but I think, if we had a little bit of a pullback here, I don't think that would bother me at all.
I don't think it would bother anybody, especially if it stays a little bit of a pullback. How much do you worry about bubble talk?
Chuck, you and I have both been around for a long time. And so when I think of bubble, I think of March of 2000, when my number and my now retired business partner, Stuart Freeman, our earnings number for the S&P 500 for the year 2000, the market was trading at 32 times that number. That was a bubble. And those companies were not nearly the kind of companies we have now. So right now, we've got a $270 number out for the S&P this year, 300 next year. Let's call it, 24, 25 times. So I don't think we're in a bubble yet, but stocks aren't cheap. And I think what we've been mainly talking to our clients about is, we've been leaning towards stocks. We like that. When the market pulled back in late March, early April, we tried to take advantage of it. We were patient coming into the year, and we've been trying to be patient lately. And I think we do think there's a reasonable potential for some downside. And I think if that happens, and there's always going to be a pullback at some point, but if or when that happens, I think you'll see us do what we did earlier in the year, which is take some money out of bonds. We don't think the 10-year yield's going much lower than where it is right now, and put that money towards stocks. So that's what we're thinking, because we've got a 7,500 target on the S&P out there for year-end 2026. So we're feeling pretty good that we're going to be in a modest growth, moderating inflation environment next year. And I think that's going to be good for the market and risk assets in general.
So much in there I want to follow up on, not the least of which is 7,500 target. The way things are going, that's basically saying modest gains. Does that change if we wind up with this year pushing us closer to that 7,000 range, et cetera, or single digits after 3 hot years is what's reasonable?
Yeah, Chuck, it could. And I'll be the first to admit that, we bumped our number up from when we were at 6,600 when we came into 2025. So, our number has moved up. And I'll tell you, it's because the labor market's been better than what we expected, and the CapEx environment has been better than what we expected, as I talked about before. So I think, we underestimated that strength. But I think that, if we see the market, let's say we run up here the last couple of months and we end somewhere around 7,000 or something like that, I think from our perspective, we've done a lot of work to try to come up with these earnings numbers and the economic environment. And I think we would be very, very hesitant and cautious to really raise that year-end target above 7,500. Like you said, 23 was great, 24 was great. Unless something crazy happens, 25 is going to be great. So, we're just about due for some more moderate return type of a year.
Well, a moderate return of type of year as opposed to something much worse, I think people will accept. Where are you on international versus domestic, given that international has seen great gains this year, but some of that is currency related At the same time, valuations there do seem to be better than valuations here.
Well, I think that's part of it. We had been neutral on developed international. We had been underweight emerging markets, and clearly both the EFA index and the emerging market index, they've done well this year. I think a lot of that is not supported by the fundamentals. I think if you try to compare what's going on, for instance, in the developed world outside of the U.S., their productivity is lower, their unemployment is higher, their growth is lower, and it's going to be tougher to kind of jumpstart those economies while we're expecting some better things here in the U.S. Now, we had been underweight emerging, and just a week or two ago, we brought that back up to neutral. So clearly, we don't like emerging markets. We don't love emerging markets, but given the underperformance, if you look back over the last few years, the combined return is quite a bit of underperformance, and so. We're not married to these international markets, and we would definitely continue to lean toward the U.S.
You talked about how if we get a setback or a pullback, you will likely take money away from bonds because you think treasury yields are as low as they're going to get, et cetera. What does that do for your expectations for the mortgage market and the housing market? Because we can want rates to go lower. We can, see the Fed cutting rates, but it's the treasury that determines what's happening with mortgages. And if mortgages don't change, neither does the housing market, does it?
Yeah, Chuck, it's funny because, Wells Fargo advisors and the Wells Fargo Investment Institute, we're catering to retail investors. And, I talk to a lot of our retail investors and, they've been under the impression that, the Fed lowers rates, that means mortgage rates are going to go down. And whether they're trying to buy a house or their kids or their grandkids are going to buy a house, they seem largely convinced that if the Fed lowers interest rates, the yield on the 10-year is going to go down, and that will lead to lower mortgage rates. But, you and I both know that doesn't happen most of the time, especially when economic growth is reasonable and expected to get better the next year. If you think about it, the Fed is lowering interest rates. They want to encourage borrowing and spending. That generally works. So you have a better economy, a little more demand, a little bit more pressure on inflation. And the 10-year yield is based on growth prospects and inflation anticipation. And so it makes sense to me that really, since the Fed cut rates a year ago, and really for the most part now, the mortgage rates, they've worked their way a little bit lower, but the yield on the 10-year is not much lower. And when I had a question about a month ago from a client, and that person asked, do you think mortgage rates are going to hit 30-year fixed at 5%? And I said, in my opinion, the only way we get there is if the economy not necessarily collapses, but really tanks here. And that would maybe shove mortgage rates lower, but I don't think that's what we want to happen. So I think mortgage rates are about as low as they can get. We're at, let's call it 6.25 on a 30-year fixed. And I would certainly encourage anybody that I know that if they want to lock in a 30-year mortgage rate, now's not a bad time to do it.
I mentioned that you had a new commentary up at the Wells Fargo Investment Institute website. And that is taking a look at the energy industry, the power industry. And of course, power's been a big story. Everybody wants to make it the AI adjacent play, et cetera. But you're looking at it in ways that are not just about AI adjacent and what have you. And in fact, you see some things changing. So talk about the energy story and why you think that's going to be a place that you want to be invested for a good long time, no matter what the rest of the market's doing.
Yeah, and Chuck, let me just first say we are not overweight the energy sector. And that's largely because what happens to the price of oil largely determines what happens to the energy sector as a whole. So we're trying to look at AI in different sectors than just technology or communication services. And the way we've tried to do that is we play it by industrials. Somebody's got to build data centers and upgrade the utility grid, and then utilities, because there's going to be a surge in demand and probably, prices are a lot higher. And so utilities are going to make money off that. But to your question on just the energy alone, for us, natural gas, renewables, whatever you think about renewables, that's going to be part of the puzzle. But I think it would be a serious mistake to think that renewables are going to be able to provide the power or a really meaningfully significant part of it for this surge in demand that we anticipate. So you look at things like natural gas. Okay, natural gas. We have a ton of natural gas. It's cheap, and I think that's going to be the main transition fuel. But as opposed to when we were kids, where people started to fear nuclear energy, whether it's Three Mile Island, what happened there, or Chernobyl, or things like that when we were younger, these new reactors tend to be smaller. They're safer. They're more efficient. Now, are they really online right now? They're not. They're coming, but they're not quite here. But when you try to think of cleaner energy that's going to be able to meet this surge in demand that we think is going to happen, I would say natural gas and nuclear. Coal will still be a big part of it, but nuclear is certainly going to be a big part of it as we look ahead over the next 10 or 15 years.
How much of that story is dependent on whatever agreement or disagreement we get out of Washington?
Clearly, energy is subject to a lot of regulation. The president has told us and has followed through that, reducing regulations when it comes to energy and as we know, other things is one of his goals. And so one thing that you do need to keep in the back of your mind, and I certainly do, is okay, these energy sources sound great, and we have these resources that we can put to use. But at some point, the Trump administration is not going to be governing, 3 years from now. And so whether it's a Republican or a Democrat or whatever administration is to come is are they going to clamp down on the regulatory backup that the Trump administration has tried to achieve? So that is a concern, but I think the demand for energy is going to be so strong that people are going to realize that, hey, solar, wind, that's all well and good, but it's not going to provide enough of the energy that we need.
Are there other industries and sectors that you particularly like as the long-term story where, again, as we're looking for reasons to believe that, we can keep the market going without having to take some sort of big setback, these would be places where you'd think, yeah, they're going to be the backbone of that?
Right now, we just recently, because of this big tech run, so we went from an overweight to a neutral in technology. We went from an overweight to a neutral in communication services. So we're trimming a little money there, trying to into the strength. What we're doing is, I mentioned utilities, I mentioned industrials. Those are two sectors we like. We also like financials because I think you're going to see a lot more M&A activity. The yield curve, we expect that to steepen a bit. That's usually good for financials. There's going to be less regulation and just more demand for loans and things like that in a better economic environment. But once again, I think, when I look at the various sectors out there, the one that I think has good long-term prospects, because whether it's utility grid or AI and data centers or just other infrastructure types of things, industrials are pretty appealing for a longer term play. Technically, financials are our favorite sector right now, but that'll come and go with the economic cycle. I think we're locked in on industrials for at least a good, probably a 5 or 10 year period.
Last question. As you pointed out, at Wells Fargo Advisors, you deal with a lot of Main Street kinds of investors. And you and I have been talking for a long time, but we haven't talked for a while. And I'm curious, where does crypto rank now? And that as in the alternative asset space? Like, you were always skeptical about it, but you also felt that mainstream wasn't necessarily going to get to where it was interested. But are they interested now?
I think retail investors are interested in crypto. I know they are interested in crypto. And, Wells Fargo has made it possible for these investors to invest in crypto. Now, we're not selling crypto, we're not buying crypto, we're not setting targets on Bitcoin or anything like that. But clients ask about it. They seem to ask a lot more about it when it's running up higher, which of course everybody likes the upside. And one thing I always ask customers, and I'll use 100,000 since we're close to that on Bitcoin. I always ask them, if you bought Bitcoin at $100,000 and 3 months later it was at $70,000, how would that make you feel? Well, needless to say, none of them say it would make them feel good. And I'd say that's the kind of volatility that you have to be willing to take if you're buying, cryptocurrencies. And so, if you can take the volatility, everybody can take it on the upside. But when it's pulled back and it pulls back fast and, you're nervous, that's a different story. So I think there's a lot of interest out there. I think that it's still limited. There's limited ways for retail investors, for the most part, to gain some exposure, but that's going to get easier, and it is easier depending on who you're dealing with, to gain access to Bitcoin. So I think it'll continue to be of interest, particularly when it's in rally mode. I still think, and Chuck, you and I talked about this, was right now the administration, they're fans of cryptocurrencies, clearly. But I still would make the argument that, these giant central banks, the Federal Reserve, Bank of Japan, European Central Bank, Swiss National Bank, you name the big top central banks in the world, they have spent a ton of money and a lot of time trying to prevent money laundering. And the last thing they want to do is have money laundering move from these major currencies to cryptocurrencies. And so I think, and I'm no cryptocurrency expert, but you have to just be in the back of your mind, you have to just think about that. And that would potentially bring more regulation and things like that may, put a damper on the enthusiasm.
Well, Scott, you never put a damper on our enthusiasm to get a chance to chat with you. It's been too long. Let's try to make sure that we don't let that happen again. But thanks so much for coming back to the show today.
Yeah, it's great to be here, Chuck, and I hope to talk to you soon.
That is Scott Wren. He is Senior Global Market Strategist at the Wells Fargo Investment Institute. It's wellsfargo.com/investment-institute. You can find the commentary I was talking about if you just follow the link in our show notes. And we are just about done with this show, but don't stop now, because then you just won't reach the finish line. We will reach the finish line together, and we've got a contest. You're going to want to know about that. That's coming up before we reach the finish line next.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
We're back to wrap this one up, and a lot to do before we get there, because we have had 3 book interviews this week, and we have all 3 books to give away. And Rob Floyd, the show's executive producer and the contest master, he is not able to join me today. So you're just going to have to deal with me. And my contests tend to be much less fun because this is not what I'm wired for. Yeah, but we'll do the best we can. And I've got something for you. So the books we have as prizes are My Mother's Money, A Guide to Financial Caregiving by Beth Pinsker from the November 4th show, Tuesday. The Perceptive Investor, The Art, Science, and Temperament of Successful Value Investing by Arda Low-Groniger from yesterday's show. And Soldier of Fortune, Warren Buffett, Sun Tzu, and the Ancient Art of Risk-Taking by Tobias Carlyle, of course, from today's show. And it is from Warren Buffett that we're going to get this contest, The Great Fortune of Warren Buffett. So to win the books, you have to tell us Warren Buffett's 3 largest holdings in Berkshire Hathaway. What are the 3 stocks he owns in the greatest quantity? And we're going to use the most recent data that we can get available that will decide that for us. You have to give them to us in order. In other words, if you name his largest holding, that gets you entered to win My Mother's Money. His second largest holding gets you entered to win the Perspective Investor. And the third gets you for Soldier of Fortune. It's that simple. If you know the 3 largest holdings, you can be entered to win any of the books. You got to give them to us that way so you can be entered for the contest. Send your entries along with your name and address to chuck@moneylifeshow.com. We're going to let this contest run just a little bit extra long, hoping that some of the folks who maybe are missing the show due to the Apple Podcast snafu can get caught up as we get this resolved and get involved. So your deadline is a full week from now. It is November the 13th at 7 p.m. Eastern Time. Send your entries to chuck@moneylifeshow.com. Put contest in the subject line of your email. And yeah, the books will be every bit as good, even if my contests are much lamer than Rob's. Tomorrow's show will not be lame. Sam Toombs, chief U.S. economist at Pantheon Macro, makes his debut on the show. And by the way, Monday, we will have Sal Gilberti, chief executive officer at Tucrium Trading. They run commodities-oriented funds, including Soybean, SOYB, the soybean fund. We will be talking current events, tariffs, commodities, and a bunch of stuff with him. So that's coming on Monday. But other great stuff coming. I just don't have the time to tell you about it now. Just trust us. And again, we're here every day that the market is open. If you cannot find us on your regular podcast app, look for us on another one. If you don't know where to look, go to pod.link and then enter the show there, and it will give you links to us on pretty much every podcast app. If you're looking for something to celebrate, today is Basketball Day, National Saxophone Day, National Cash Back Day, and it's National Men Make Dinner Day. What do you do in my house? Because I make dinner pretty much every day. In fact, I'm planning to make it tonight. It's just not going to be a holiday, but it'll be something nice. I have London broil planned for tonight. By the way, it is also National Nachos Day, and you can wash it all down with a nice stout.
Beer.
Because it's International Stout Day. My guests were Todd Rosenbluth, head of research at Vetify. Go to vetify.com for more information. Tobias Carlisle, author of Soldier of Fortune, Warren Buffett, Sun Tzu, and the Ancient Art of Risk-Taking. He runs the Acquirers Funds at acquirersfunds.com. We do have a link to the book page in our show notes. And then Scott Wren, senior global market strategist for the Wells Fargo Investment Institute. wellsfargo.com/investment-institute. We also have the link to his commentary in our show notes. Thanks to them. Thanks to Rob Floyd, my producer, even if he couldn't be here for this part of the show. Thanks to Maho, my dog, who could, but didn't make that noise because he's a good boy. And mostly thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day is the fourth in a series of quotes from an interview I did a year ago today with Jason Zweig from the Wall Street Journal. And he said, investors have a more urgent obligation than ever to ensure their own heads are screwed on straight. Yeah, that's one of the reasons you come to us, to get your head screwed on straight and to get perspective on money. And that means you're going to remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Know what I mean? Know what I mean? Nudge, nudge, know what I mean? Say no more.